Hello and welcome. Today, we are going to learn how to use volume to identify trading opportunities. Volume is one of the most reliable tools for spotting key moments in the market, and by the time we finish, you will understand how to use it to confirm trends, find breakouts, and spot potential reversals. This will help you make better trading decisions. Before we jump into the details, imagine having a tool that helps you see beyond just price movement. A tool that reveals the strength behind every move, the intentions of traders, and the potential turning points in the market. That tool is volume. Stick around because we are about to uncover how volume can guide you to smarter trading decisions. We will also dive into specific strategies that could make a real difference in your trading journey, including an expanded look at chart patterns and how volume plays a crucial role in interpreting them. Ready to learn something new? Great! Let us dive in. Volume in trading simply means the number of shares or contracts traded during a specific period. It shows how much interest and activity there is for a particular asset. So why is this important to us as traders? Well, because volume tells us how strong a price move really is. If a lot of people are buying or selling, it tells us whether a trend or a breakout is likely to be reliable. When there is high volume, the move means more because more people are taking part. It is like a vote. The more votes, the clearer the result. So, volume helps us understand the real strength behind a price change. Let us talk about how we can use volume to confirm a trend. When a stock is moving up in price, that is called an uptrend. Volume can help us figure out if that trend is strong or weak. If the price is going up and volume is rising as well, that means more and more people are buying and supporting the price increase. That is a good sign because it indicates broad participation and conviction among traders. On the other hand, if the price is going up and volume is falling, it means fewer people are interested in buying at those higher prices, and there is less conviction behind the move. The trend might be running out of steam, and we should be careful. This concept can be further understood using chart patterns such as the **, rising wedge, **, or **, ascending channel, **. In a **, rising wedge, **, price continues to rise but within a narrowing range, and volume often declines as the pattern progresses. This is a warning sign that momentum is weakening, and a reversal could be near. The narrowing price movement and decreasing volume suggest fewer traders are willing to buy at the higher prices. When the price breaks down from the wedge with a surge in volume, it confirms that the uptrend is over. In an **, ascending channel **, price moves within two parallel upward sloping lines showing a clear uptrend. Volume analysis is crucial here. If volume is strong during the upward swings and weaker during the pullbacks, it confirms that the trend is healthy. However, if volume starts to decline during upward movements or increases during pullbacks, it may signal that the trend is losing momentum and a breakout from the channel could be imminent. Watching volume within these channels gives a clearer sense of whether the trend will continue or break down. These patterns, along with volume analysis, help us not only identify ongoing trends, but also anticipate potential reversals. A strong trend is typically accompanied by consistent or increasing volume, while a weakening trend often shows declining volume. By understanding these dynamics, we can make better informed decisions about when to stay in a trade and when to prepare for an exit. The same thing works in a downtrend when the price is dropping. If the price is falling and volume is increasing, it means more people are selling and the downtrend is strong. But if the price is falling and volume is also dropping, it means fewer sellers are interested at those lower prices. The trend could be losing strength, and it may be time for a reversal. This is important because these moments can give us trading opportunities. If we can spot when a trend is about to weaken, we can prepare for a change in direction. Now, let us move on to talking about breakouts. A breakout happens when a price moves beyond a key level of support or resistance. This can indicate that a new trend is starting, but not every breakout is one we should trust. This is where volume becomes incredibly important. A ** breakout with high volume * is more likely to succeed because it shows strong market participation. The more traders that get involved, the more solid the breakout becomes. Think of it like a door being pushed open. If a lot of people are pushing on it, the door will fly open easily and stay open. However, if only a few people are pushing, the door may not open fully or could close again quickly. This analogy helps us understand that volume is what gives the price move strength and sustainability. High volume during a breakout indicates that there is widespread interest, and it helps confirm that the price is likely to continue in the direction of the breakout. It is especially important when the breakout is occurring at a significant level, such as a long-term support or resistance level. Traders are more confident in such moves when they see that volume is spiking alongside the price. On the other hand, a ** breakout with low volume * can be very risky. This could indicate a ** false break out ** where the price seems to be breaking out but does not have enough participation to sustain the move. These false breakouts are tricky and can catch traders off guard. The price might break above a resistance level or below a support level, only to return back into the range soon afterward. This often leaves traders who entered the position stuck or with a loss. Therefore, always check the volume when you see a breakout. Another useful pattern to watch for is the ** breakout retest pattern **. This happens when the price breaks through a key level with high volume and then comes back to retest the same level. If the retest occurs with lower volume and is followed by a new push in the breakout direction with high volume, this is a strong confirmation of the breakout's validity. The retest gives an opportunity to enter the trade with more confidence, knowing that the breakout level has now turned into a support or resistance zone. We also have ** symmetrical triangles **, which often lead to breakouts. These triangles occur when the price starts to consolidate into a narrowing range. When a breakout happens from a symmetrical triangle, volume should ideally surge, confirming that traders are supporting the new trend direction. A breakout without volume from a symmetrical triangle might mean the breakout will fail, causing the price to revert back into the triangle pattern. A ** breakout gap * is another pattern worth mentioning. This is when the price gaps beyond a key level, often due to significant news or earnings releases. If this gap happens on high volume, it strongly confirms the breakout, signaling that many traders are backing the move. However, if a gap forms with low volume, there is a greater risk of the gap being filled, meaning the price could move back to where it started. Breakouts can also occur within **, flag, and pennant patterns **. These are short-term continuation patterns that appear after a strong price move, and they indicate a brief consolidation before the trend resumes. A breakout from a flag or pennant on high volume gives a strong indication that the previous trend will continue. The increased volume shows that more traders are joining the move, adding to its strength. By analyzing volume with breakouts, we can differentiate between real breakouts and false signals. Always remember that volume provides a confirmation that a breakout is genuine and helps reduce the risk of getting caught in failed moves. This is why it is essential to not just look at price action, but also factor in volume analysis before making trading decisions. Let us talk about reversals. Reversals are when a trend changes direction, and volume can be a great way to spot these moments. Imagine the price is falling, but suddenly we see a big spike in volume. This could mean that buyers are stepping in and that the trend might reverse. It is like seeing a crowd suddenly rushing to one side of a room. If we see a lot of people moving in, it can mean something is about to change. Another great way to identify reversals is to look for something called divergence between price and volume. If the price is moving one way, but volume is moving the other, that means the trend is weakening. This can be a very strong indicator that a reversal is coming, and if we are ready, we can take advantage of it. Now, there are also specific indicators that can help us make the most of volume information. One of these is called on-balance volume. On-balance volume tracks whether volume is flowing into or out of an asset. If on-balance volume is going up while the price is staying flat or even falling, that is a sign that buyers are quietly getting involved. It could be a signal that we might want to buy before the price really starts to move. Another useful indicator is the ** volume weighted average price ** or VWAP. This tells us the average price weighted by volume, and it helps us see whether the price is above or below a fair value. VWAP is commonly used as a benchmark for determining whether a security is trading at a premium or a discount. When the price crosses above the VWAP, it can indicate that buyers are gaining strength, and this might be a good opportunity to enter a long trade. Conversely, if the price crosses below the VWAP, it could signal that sellers are taking control, presenting a potential short selling opportunity. The ** accumulation distribution line ** is another great tool. It measures the cumulative flow of money into or out of a stock over time. This indicator looks at both the closing price and the trading range to determine whether money is flowing into or out of the asset. If prices are rising but the accumulation distribution line is falling, it could be a warning that the uptrend is not as strong as it seems, signaling a possible reversal. On the other hand, if prices are falling and the accumulation distribution line is rising, it might suggest that buyers are stepping in and that the downtrend may soon reverse. We also have the ** money flow index MFI**, which is a momentum indicator that uses both price and volume to measure buying and selling pressure. The money flow index can help identify overbought or oversold conditions. When the MFI moves above 80, it is typically considered overbought, and when it drops below 20, it is considered oversold. Volume plays a critical role here, as spikes in volume while the MFI is in these extreme zones can signal a potential reversal. Another important volume indicator is the * check in money flow CMF**. This indicator also helps assess the buying and selling pressure based on volume. If the CMF is above 0, it suggests that there is strong buying pressure, while values below 0 indicate selling pressure. Watching how the CMF moves in conjunction with price trends can help confirm breakouts or reversals. For instance, If the price is breaking out to new highs but the CMF is declining, it could be a warning that the breakout lacks the necessary volume strength and may not sustain. The **Klinger volume oscillator * is another tool that combines short-term and long-term volume flows to predict price reversals. When the oscillator crosses above its signal line, it suggests that buying pressure is increasing, while a cross below the signal line suggests that selling pressure is building. This indicator can be particularly useful when combined with other volume-based tools to confirm market trends. These volume-based indicators help us get a more complete picture of what is happening in the market and can give us a heads up about opportunities or risks. By combining these tools with price action, we can significantly enhance our trading strategies and make more informed decisions. The accumulation distribution line is another great tool. It measures the flow of money into or out of a stock over time. If prices are rising but the accumulation distribution line is falling, it could be a warning that the uptrend is not as strong as it seems. These volume-based indicators help us get a more complete picture of what is happening in the market and can give us a heads up about opportunities or risks. Volume is also really helpful when we use it alongside candlestick patterns. Candlestick patterns are a way to look at price movements visually, and when we combine them with volume, they become even more powerful. Let us expand on some specific chart patterns and how volume plays a role in interpreting them. One key pattern is the ** bullish engulfing pattern **. This is when a small red candle is completely engulfed by a larger green candle, showing a reversal from a downtrend to an uptrend. When this pattern is accompanied by high volume, it is a strong signal that buyers are stepping in, and the trend is likely to continue upward. High volume confirms that there is strong interest backing up the price movement, making it a more reliable signal. Another pattern is the ** bearish engulfing pattern **. This happens when a small green candle is followed by a larger red candle that completely engulfs the previous one. If this pattern is accompanied by a significant increase in volume, it suggests that sellers are taking control and a downtrend may be on the horizon. The increased volume is crucial because it confirms the strength of the bearish move. The ** hammer and hanging man patterns ** are also important. A ** hammer * appears at the bottom of a downtrend and signals a potential reversal. It has a long lower shadow and a small real body at the top of the trading range. When we see a hammer with high volume, it indicates that buyers stepped in aggressively after an initial sell-off, increasing the chances of a reversal. On the other hand, the ** hanging man * is the same shape as the hammer but appears at the top of an uptrend. High volume here indicates that sellers are starting to gain strength, potentially leading to a reversal. The ** doji pattern * is a classic candlestick pattern where the opening and closing prices are nearly equal, forming a cross or plus shape. A doji represents indecision in the market. When we see a doji after a strong uptrend or downtrend, and it is accompanied by high volume, it can signal that the current trend is losing momentum and a reversal could be imminent. Volume helps validate the significance of the doji. Without high volume, the doji may not be a strong enough indicator on its own. **, morning star and evening star patterns ** are also very telling. A ** morning star * is a bullish reversal pattern that forms after a downtrend and consists of 3 candles: a large bearish candle, a small indecisive candle, and a large bullish candle. When this pattern appears with rising volume, especially on the third candle, it suggests that the buying interest is significant and that the trend is reversing upwards. An *** evening star ** is the opposite, appearing at the end of an uptrend and signals a bearish reversal. High volume during the formation of the third candle in this pattern adds confidence that sellers are taking control. Another useful pattern is the ** cup and handle **. This is a bullish continuation pattern that looks like a rounded bottom followed by a short consolidation that resembles a handle. When the price breaks out of the handle with a surge in volume, it signals that the bullish move is likely to continue. Volume is crucial here because a breakout with low volume can indicate a lack of conviction, increasing the risk of a false breakout. The ** head and shoulders pattern * is a reversal pattern that can occur at market tops, head and shoulders, or bottoms, inverse head and shoulders. In both cases, volume plays an essential role. For a standard head and shoulders pattern, volume should decrease as the pattern forms and then increase significantly during the breakout below the neckline. This volume increase is a strong signal that the reversal is valid and that sellers are taking control. In the case of an inverse head and shoulders, rising volume during the breakout above the neckline signals that buyers are gaining momentum. ** triangles * are also common patterns, such as ** ascending, descending, ** and ** symmetrical triangles **. In an ** ascending triangle **, if the price breaks above the resistance line with high volume, it signals strong buying interest and that the price is likely to move higher. In a ** descending triangle **, a break below support with increasing volume is a strong bearish signal. For ** symmetrical triangles **, volume tends to decrease as the pattern progresses, and a breakout with a large increase in volume signals the direction of the new trend. By paying attention to the volume associated with these chart patterns, we can gain greater confidence in our trades and make more informed decisions. Watching how volume behaves around these classic chart patterns helps us confirm whether a trend is likely to continue or reverse, giving us a significant edge in our trading strategies. For example, if we see a bullish engulfing pattern with high volume, that is a very strong signal to buy. On the other hand, if we are already in a trade and volume starts to fade, that can be a sign to get out. When volume decreases, it means the price move is losing strength and the trend could reverse soon. This is why it is so helpful to watch volume closely. Let us talk about some specific trading strategies using volume. One of the most effective strategies is called the breakout strategy with volume. If the price breaks out of a key support or resistance level with a significant increase in volume, that confirms that the breakout is likely to hold. We can enter that trade with more confidence, knowing that volume is backing up the move. Another strategy is the reversal strategy with volume divergence. If we see that the price is making new highs but volume is decreasing, that is a sign that the trend may be about to reverse. We can enter the trade when we see clear signs of reversal, confirmed by a spike in volume. This helps us catch the change in direction before it becomes obvious to everyone else. And then there is the trend continuation strategy. This one is really helpful during strong trends. We can look for pullbacks that happen with low volume. When the volume picks up again and the price resumes the trend, it is a good signal to enter or add to our position. These strategies are all ways we can use volume to help us make better trading decisions. We also need to talk about managing risk with volume. One way to manage risk is by using volume to help with stop-loss placement. For example, we can place our stop-loss just beyond key volume levels. In an uptrend, if the price falls below a support level with high volume, that may signal the trend is reversing. We want our stop-loss just below that level to limit our risk. Another way to manage risk is by adjusting our position size based on volume strength. If there is high volume, it means the move is stronger, and we might choose to take a larger position. If volume is low, it means the move is weaker and we should take a smaller position to minimize our risk. It is important to be flexible and adjust based on what volume is telling us. There are also some common mistakes that traders make when using volume. One mistake is ignoring volume during breakouts. If we enter a breakout without checking the volume, we could get caught in a false breakout. Always look at the volume to make sure the move is backed by strong participation. Another mistake is overreacting to small volume spikes. Not every volume spike means that something big is happening. It is important to look at the bigger picture and combine volume analysis with other indicators before making a decision. And finally, do not trade without considering the market context. Volume alone does not tell the whole story. It is best to combine volume with other tools like trend lines, moving averages, and fundamental analysis to make the best decisions. We can also combine volume with other indicators to get a more complete picture. Moving averages work really well with volume. For example, if the price moves above a moving average with high volume, that strengthens the signal to enter the trade. Another indicator is the relative strength index. When volume spikes in an oversold market, that can be a strong buying opportunity. Finally, Bollinger Bands are another great tool. If the price breaks out of the Bollinger Bands with high volume, that is a more reliable signal that the breakout will continue. By combining volume with these indicators, we can improve our chances of success. Let us quickly recap what we have learned. Volume is a key tool for confirming trends, breakouts, and reversals. It helps us understand the strength of a move and spot opportunities before they become obvious on price charts. Start by incorporating volume analysis into your trading strategy. Watch for volume spikes at key levels, use volume indicators like on balance, volume, and volume weighted average price, and always combine volume with other technical tools to improve your accuracy. The more you practice using volume in your analysis, the better you will get at spotting high-quality trading opportunities. Keep practicing and refining your understanding. Engage with the market, ask questions, and continue learning. Over time, you will build the skills to make more informed and confident trading decisions. Stay patient, keep at it, and remember that every bit of knowledge you gain brings you closer to success.